Monetary Policy Committee, MPC, of the Central Bank of Nigeria, CBN, held its 298th meeting on the 25th and 26th of November 2024 to review recent economic and financial developments, as well as assess the risks to the outlook. All 12 members of the committee were in attendance. Decisions of the MPC. The committee was unanimous in its decision to further tighten policy, and thus decided as follows. 1. Raise the MPR by 25 basis points to 27.50% from 27.25%. 2. Retain the asymmetric corridor around the MPR at plus 500 to minus 100 basis points. 3. Retain the cash reserve ratio of deposit money banks at 50% and merchant banks at 16%. 4. Retain the liquidity ratio at 30%. Considerations. The meeting was held on the backdrop of renewed inflationary pressures as the headline food and core measures rose year on year in October 2024. The committee was particularly concerned that all three measures also inched up on a month-on-month basis, suggesting the persistence of price pressures with attendant adverse impact on income and welfare of citizens. Members, therefore, agreed unanimously to remain focused in addressing price developments. While food prices remain a key contributor to the uptick, members commended the efforts of the federal government for the improved security, especially in the northeast of the country, which would likely improve food production. The committee also noted the role of rising energy production. The recent increase in the price of premium motor spirit, PMS, has also impacted the cost of production and distribution of food items and manufactured goods. The committee was optimistic that the full deregulation of the downstream subsector of the petroleum industry would eliminate scarcity and stabilize price levels in the short to medium term. Members thus reiterated the need to strongly forge ahead and fiscal authorities to ensure the achievement of our synchronized objectives of price stability and sustainable growth. The committee noted the improvement in the external sector, reflected by the increase in the current account surplus, enhanced remittance and capital inflows, which have impacted the external reserves positively. This, therefore, suggests that key policy measures by both the monetary and fiscal authorities are yielding the desired outcomes. Members, however, expressed concern over persisting exchange rate pressure, reflecting continued high demand in the market. Consequently, the committee urged the bank to explore measures to boost market liquidity. Members noted with satisfaction the continued resilience and stability of the banking system, despite significant exogenous and endogenous headwinds. Key financial soundness indicators such as the Capital Adequacy Ratio, CAR, Non-Performing Loan Ratio, NPL, Liquidity Ratio, LR, amongst others, remain strong. The MPC, however, called on the bank to maintain its close surveillance on the banking system to sustain compliance with regulatory threshold and continued health of the industry. The MPC acknowledged the efforts of the bank in deepening financial inclusion towards improving the transmission mechanism of monetary policy to enhance policy effectiveness. From the foregoing, members thus focused on the optimum policy choice to address the uptrend in price development, stabilize the exchange rate, and anchor inflation expectations appropriately. Key developments in the domestic and global economies. Data from the National Bureau of Statistics showed that headline inflation year-on-year rose to 33.88% in October 2024 from 32.70% in September 2024. On a month-on-month basis, it also rose to 2.64% in October 2024 from 2.52% in the previous month, with both the food and core components contributing to the continued rise in headline inflation. Food inflation rose further to 39.16% in October 2024 from 37.77% in September, while core inflation also rose to 28.37% in October 2024 from 27.43% in September. The MPC, however, noted the moderation in the prices of farm produce and commended the efforts of the federal government in driving increased productivity in the agricultural sector. The recovery of output growth was sustained, with real GDP year-on-year growing by 3.46% in the third quarter of 2024 compared with 3.19 and 2.54% in the preceding and corresponding periods, respectively. The growth was driven by both the oil and non-oil sectors, with a notable contribution from the services sector. The non-oil sector grew by 3.37% in the third quarter compared with 2.80% in the second quarter, while the oil sector grew by 5.17% year-on-year compared with 10.15% in the preceding quarter. The external reserves rose marginally to 40.88 billion as of 21st November 2024 from 40.06 billion at end of October 2024, available to finance 17 months of imports. At the global level, the IMF projects growth at 3.2% for 2024 and 2025 from 3.3% in 2023. Risks to this outlook, however, include ongoing geopolitical tensions such as the lingering war between Russia and Ukraine, as well as the crisis in the Middle East. The deceleration in global inflation is expected to continue into 2025 and move towards the long-run objectives of key central banks in the advanced economies, albeit at a slow pace. This, however, faces a growing risk of reversal as talks of trade tariffs heighten following the outcome of the November 2024 United States elections. In view of the above developments and identified risks, members reiterated their commitment to price stability as the bedrock of a thriving Nigerian economy. The next meeting of the committee is scheduled to hold on the 25th and 26th of January 2025. Thank you.
Thank you very much, Mr. Governor, sir. That was communique number 155, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Kadusu. We'll now take questions from members of the press. Please state your name, your medium, and ask your question. Do not ask more than one question, please. Thank you.
A very good afternoon. Very good afternoon, everyone. Well, my question is, with inflation at, the name is Musa Abubakar. I'm with NTA. My question is, with inflation at 33.88% in October, up by 1.18%, what steps will the CBN take to meet its 21% target for 2024? Thank you.
Thank you very much, Musa. Let me first say that the central bank is resolute and committed to continuing to fight the war against inflation. There's no going back on that. And as I have said at previous fora, we are going to deploy everything in our arsenal to ensure that we are able to tame it. And of course, this entails the return to orthodox monetary policies. The return to orthodox monetary policies. So I think it is important to state that upfront. There's no going back on that. Now, it's also important for people to understand that there's a time lag between when you implement policies and when they have an impact. And that time lag, quite frankly, can be, anything up from 6 months to 9 months to a year. It all depends on what you're doing. Our own perspective is that we expect to see greater results in the first quarter of 2025. And you can do the math from the time we started tightening. So we expect to see this in the first quarter of 2025. In addition to that, we are working very assiduously with some of the relevant agencies to ensure that those structural impediments are handled appropriately. Some of these things themselves take time: supply disruption, infrastructure, a whole host of different things. And ours is to collaborate, to advise, and to help such that at least we begin to make that transition to a point where these issues are adequately dealt with. On our own also, we are doing what we can within the limits of our market, and in particular the foreign exchange market. And by that I refer to the fact that we appreciate that many times some distortionary elements come into a market, and that is why we as regulators, that's what we are there for. So we are ensuring that we're on top of the game, and that the foreign exchange market operates at its most optimal manner, and so it will reflect the true value of the currency, and of course you have price discovery. Then finally, something else I think is important to say, and that is that if you, and for many of you, many of the press, many of the members of the press who were at the World Bank IMF meetings recently, you see those fora also offer an opportunity to interact and to exchange views and rub minds with people who come from different parts of the world. And really and truly, if there's anything those people that attend should get out of that, it is that. Talk to people in other parts of the world, see how they themselves have dealt with some of the challenges that we are facing. And you find out that we are not alone. We are not at all alone, and that the road of travel is similar. These things take time. You've got to stay the course, and you reap the benefits. And for those who, again, have made it their duty to monitor how different economies handle these kinds of problems, if you talk to them when you visit these kinds of events, you can see that the expectation is that Nigeria definitely is on the right path and will continue to be as far as inflation and foreign exchange management is concerned. So I think the bottom line of all this is that these are all time-bound issues, and we do expect that in the fullness of time we will begin to see the greater reaping of some of the benefits of the great tightening and the sacrifices that everybody in the country has made.
Thank you, Mr. Governor. My name is Mark Tiber from Leadership Newspapers. So there are reports already that the foreign reserve has risen, for instance, like you said, to $40.88 billion. That's a good achievement. And then the foreign remittances, over $600 million. But I want to know, what will be your reaction or your response to those who are concerned that despite this rise in foreign reserve and the foreign remittances, that the Naira's exchange against the foreign other currencies, especially the dollar and the pound sterling, is still very weak? What will be your response to them, sir?
Thank you very much. Yes. Okay, first and foremost, maybe I should unpack that question a little bit. Diaspora remittances, absolutely, they've gone up. And I would say that they didn't just go up on their own, they went up as a result of a deliberate policy on the half of the central bank, and I've said this in previous fora, to address all the bottlenecks that were in the way of diaspora remittances coming into the country. So that has happened and will continue to. Then, of course, the whole issue of reserves, that yes, indeed, the reserves have gone up. The reserves have gone up. And again, we should bear in mind that the process of getting us to where we are with reserves has been a long, tedious one. And those of you who can recall, when this particular administration started, we had a lot of problem with reserves. We had relatively lower reserves, early 30s, and we had a huge backlog. And happily, all those things are behind us now. They are behind us. And I think that is a clear indication of the fact that the policies that have been used have begun to bear fruit. They have begun to bear fruit.